Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. We are diving deep into a period of, well, just extreme market dissonance right now. We're focusing on two huge simultaneous shifts that really redefined what investors were expecting as 2025 started to wrap up. And this isn't just about, normal market cycles. This is about fundamental structural engineering. One financial, one technological. So today, we really need to understand how U.S. financial regulators pulled off what you could only really call a regulatory end run.
Right.
To pump just vast amounts of liquidity into the banking system. It's essentially stealth QE.
And at the exact same time, you've got this other thing happening, the most aggressive corporate restructuring, I think, in recent history.
Yeah.
We're talking about Elon Musk's experiment at X.
Yeah.
He's rapidly building the blueprint for what some are calling the humanless corporation using these very advanced AI agents.
So you have these two massive forces, huge financial intervention and this radical tech replacement. And they are the primary drivers of portfolio decisions right now.
Yeah, they are. And they both promise this short-term relief or hyper-efficiency. But they also introduce these profound, almost existential long-term risks.
So our mission today is to really dissect the mechanisms behind both. Why did the regulators seem to panic? What exactly is an AI agent doing that a human can't? And look, most critically, what does all this volatility mean for your portfolio?
For everything from bank stocks to tech giants to hedges like gold and treasuries.
Exactly.
What's immediately striking when you look at the materials is just the scale of the intervention. In finance, you have regulators just overriding established safety rules to force liquidity into the system.
And in the corporate world?
It's a CEO overriding established human organizational structures to force efficiency. Both systems are being manipulated at the highest level, and that demands critical attention because the outcomes, good or bad, they're not going to be gradual. They're going to be systemic.
Okay, let's unpack this. We have to start with the financial fix, the immediate crisis. Let's call this Section 1. The FDIC's liquidity fiver, unpacking stealth QE. So we need to set the scene here. Leading up to this big decision, in early November 2025, the U.S. financial system was rissing. It was showing some real signs of stress. What exactly was this spasm that happened that made the FDIC and the Fed act so decisively just a few weeks later?
Well, the stress was coming from a few places, but the immediate alarm bell, the one that got everyone's attention, was the repurchase agreement market, the repo market.
The repo market.
It had a sharp, sudden seizure. And the data shows this was made worse by what looked like really weak demand of the huge number of U.S. Treasury bonds the government was trying to sell.
Right, and for anyone listening, the repo market might sound like some abstract Wall Street thing, but it is so critical. It's basically the short-term cash ATM for the entire financial world. Can you maybe elaborate on why a seizure there is just so dangerous?
Absolutely. Think of the repo market as the grease in the gears of the whole global financial system. Banks, hedge funds, they all use it to borrow cash for really short periods, often just overnight.
And they use things like U.S. Treasuries as collateral, right?
Exactly. High-quality assets. It's the mechanism that ensures everyone has the cash they need day to day. So if the interest rate for that overnight borrowing suddenly spikes, it means one of two things is happening. Either cash is suddenly super scarce, or the collateral, the treasuries, are suddenly seen as too risky.
And when that ATM just seizes up and these huge institutions can't get the cash they need to settle their books for the day, liquidity just vanishes instantly. And that creates this immediate risk of like a domino effect, cascading failure.
Precisely. And you couple that repo spasm with weak demand for new government debt, and the danger just gets amplified. The U.S. government is constantly issuing hundreds of billions in new debt to operate.
If the market isn't buying it.
If the market isn't absorbing that debt, the price of existing bonds falls, rates go up, and that tightens financial conditions even more. It becomes a vicious cycle, a failure of liquidity, confidence, and debt absorption all at once.
So the regulators had two problems to solve. They had to stabilize the short-term cash markets, and they had to make sure the government could keep funding itself without sending borrowing costs through the roof.
Right. And their response was to basically bypass the usual monetary policy tools. They used regulatory change to solve both problems at the same time.
And this is the core of it, right?
This is the core takeaway. Instead of, the Fed buying bonds on the open market, which can be slow and signals weakness, the FDIC and the Fed decided to just change the definition of risk for the biggest banks. They basically said, you guys are now the buyers of last resort for government debt.
And they used regulation to do it.
Regulation was the tool.
Okay, so this whole fix hinges on one single rule.
Yeah.
the supplemental leverage ratio, or SLR. Before we get to the change, can we just quickly revisit why the SLR was even created back after 2008?
Yeah, it was a cornerstone of the Dodd-Frank reforms after the big financial crisis. And its purpose was brutally simple: stop banks from getting dangerously overleveraged again.
Right.
Before that, banks could load up on what seemed like low-risk assets without holding much capital against them. The SLR says, no, you have to hold a minimum amount of your best capital Tier 1 capital as a percentage of all your assets, no matter how risky you think they are. It's the final safety cushion.
So it's just a simple hard floor for bank safety. No matter what you own, you have to have this much cash on hand relative to your total size.
Correct. And this is where the regulatory sleight of hand happened in November. The final approval temporarily excludes or drastically reduces the risk weighting of U.S. Treasuries and bank reserves from the total asset calculation in the SLR.
Wait a minute. This is where I have to kind of push back. The official line was that this was just a minor technical adjustment, to help markets function. But if you just decide $1 trillion in Treasuries no longer counts toward that calculation, doesn't that fundamentally gut the whole point of the rule?
Yeah. It absolutely does. And this is exactly why the sources we've seen are calling it stealth QE. By removing treasuries and reserves from the asset base for that calculation, you instantly, artificially make every major bank's balance sheet look safer.
Without them actually doing anything?
Without them raising a single dollar of new capital. A bank holding huge amounts of government debt suddenly has regulatory room to take on way more leverage.
Let's use that other analogy. If you usually have a limit on how many heavy boxes you can carry based on your own strength, that's your capital.
Right.
The government just declared that all of its biggest, bulkiest boxes, the treasuries, now weigh almost nothing. So you can suddenly carry way, way more of their boxes.
That's a perfect way to put it. And because their leverage ratio looks so much better on paper, they can now use that new capacity to do two things.
Buy more treasuries that the government needs to sell.
Check.
Yeah.
And dramatically expand their lending to businesses and consumers.
Exactly. This is the definition of stealth QE. Regular QE is the Fed buying assets directly. This is the Fed and FDIC using regulation to force the banks to buy the assets. It achieves the same liquidity injection, just indirectly.
It's brilliant, it's subtle, and it is fundamentally destabilizing in the long run.
Okay, so regardless of the long-term risk, the short-term market reaction was, well, it was totally unambiguous. Immediate confidence, a rush of liquidity. The moment this ruling was finalized in late November, what did we see happen in the market?
The first and most obvious indicator was the immediate strong surge in major financial stocks. We're talking JP Morgan, Bank of America, Wells Fargo. All of them saw significant gains.
Because the market understood this was a massive free capital injection for the banks.
Instantly. And the gains were driven by two clear expectations. First, more interest income. They're basically being handed a guaranteed low-risk portfolio of high-yielding treasuries they can make money on.
That's one half.
The other half, maybe the more powerful half, is the expanded lending capacity. Because the ratios suddenly looked healthier, they had the green light to issue more commercial loans, more mortgages, more corporate credit.
More lending equals more profits.
It's a guaranteed boost to their return on equity without having to change a thing about their business.
And what about the original problem, the repo market spasm? How did this fix that?
The repo market stabilized almost immediately. If the banks are now incentivized or, practically mandated to hold massive amounts of treasuries, then those treasuries become way more liquid and trustworthy as collateral.
So cash starts flowing again.
The cash started flowing again because the underlying collateral stability was suddenly guaranteed by the regulator's blessing.
And this fix, timed just perfectly, seems to be the main reason we saw so much optimism at the end of the year. We're talking about a powerful Santa rally catalyst here.
Absolutely. When liquidity pours into the system, whether it's direct QE or this kind of stealth QE, it doesn't just stay in the banking system, it flows out into broader asset markets.
Everyone feels safer taking on risk.
Traders feel safer, investors feel wealthier, the whole environment just becomes more exuberant. And this sudden flood of cash and credit is feeding expectations for gains across the board, especially in riskier sectors like growth tech. The system is just swimming in easy credit right now.
Okay, this is where we have to pivot from the party to the potential hangover. The data we reviewed consistently brings up this idea of the bank government doom loop. So the morphine is working now, but what specific long-term systemic risks have the regulators just created?
The risk is concentration. And it's coupled with moral hazard. By giving this exemption, the regulators are actively encouraging the biggest banks to load their balance sheets with U.S. government debt.
Because if treasuries are treated as risk-free in the calculation, the bank has a huge incentive to hold as much as possible to maximize its lending capacity.
But treasuries aren't truly risk-free, are they? Especially when you think about interest rate volatility. If rates spike up, the market value of those bonds plummets.
Exactly. And that is the core of the doom loop. If we see a sharp rise in inflation or interest rates in the future, those massive treasury holdings, the very ones banks were exempted from capitalizing against, will suffer huge losses.
And that erosion of their bond portfolio's value could quickly compromise a bank's solvency, leading us right back to the crisis scenario we were trying to avoid.
This is more than just an echo of the 2023 banking crisis. This sounds like recreating the exact preconditions for the failure of Silicon Valley Bank, SVB, but on a massive, regulator-approved scale affecting the biggest banks in the country.
The parallel is chilling. SVB failed because its portfolio of long-dated bonds lost huge value when the Fed raised rates. When depositors got scared and pulled their money, SVB had to sell those bonds at a loss, which triggered a total crisis of confidence.
And now we're encouraging the biggest, most important banks to hold even more of this kind of debt.
We're weakening the structural safety net at a time of very high government debt and potential inflation. The government is essentially shifting its own funding risk onto the banking sector's shoulders.
And this flood of easy money, it doesn't just affect the banks. It bleeds into the real economy, specifically by propping up what are called zombie companies.
Right, this is the economic side effect of the morphine. By keeping credit cheap and plentiful, you stop necessary economic restructuring from happening. A zombie company, based on the definition in the materials, is a company whose operating profits aren't even enough to cover the interest payments on its debt.
They only survive because borrowing is artificially cheap.
And liquidity is always available. They're on life support.
So if these inefficient companies are kept alive by this policy, what's the cost to the overall health of the economy?
The cost is stagnation. Healthy economies need what's called creative destruction. Inefficient companies fail, which frees up capital, labor, and resources for new dynamic companies. When the zombies don't die, they hoard capital, they stifle innovation, and they depress wage growth.
So the stealth QE might get rid of short-term market pain.
But it acts like a debilitating drug on the long-term health of the economy. It's masking deep-seated problems that are only getting worse under the surface.
So we've got this powerful paradox. Great for the short term, but potentially terrible for the long term. How does an investor navigate this? Let's break down the strategy for 3 different time frames.
Okay, the short-term strategy is pretty simple. It's dictated by the flow of liquidity. You have to ride the wave until the music stops.
Which means leaning into the immediate winners from these rule changes. Our analysis points directly to the big bank stocks, JPM, Bank of America, Wells Fargo. The market's reaction is just too powerful to ignore when their balance sheets are instantly improved like this.
And it's not just financials. This kind of risk-on environment is great for growth sectors. Tech stocks, especially on the NASDAQ, they thrive on cheap capital. Even, non-traditional risk assets like Bitcoin can benefit when people feel that money is abundant.
So the actionable advice for the next few months is pretty clear. Participate in the liquidity party. You have to recognize the market is being structurally propped up.
For now.
Okay, now let's move to the medium term, the Treasury opportunity. Why does this stealth QE create a sort of powerful floor for bond investors?
Because the banks are now essentially captive buyers. The regulatory incentive is so strong that they will constantly be there to absorb new Treasury issuance. This guaranteed buying power creates a floor under bond prices.
Which means interest rates can't spike too aggressively.
Because if they did, it would trigger a massive new round of bank buying to stabilize them.
So if you're an investor looking for stable income, especially in a volatile world, short to mid-term U.S. Treasury notes suddenly look very attractive.
They offer a yield that's structurally protected by the bank's mandatory demand. And that's a key distinction. You're not just investing in the government's credit anymore. You're investing in the regulatory structure that guarantees demand for that credit.
Okay, finally, the long-term hedge. This is about that doom loop risk. If this kind of major regulatory easing often comes before major instability, what's the insurance policy investors need to have in place?
You need an asset that does well when confidence in both the banking system and fiat currency is challenged. The data overwhelmingly points to maintaining a dedicated allocation to physical safe haven assets, specifically gold.
Why gold over, say, just holding cash?
Because the doom loop suggests two possible negative outcomes. Either the system successfully absorbs all this debt, or, more dangerously, the system fails and the massive debt is just inflated away.
And gold protects against both.
Gold is the ultimate hedge against both systemic banking instability and the debasement of currency that comes from all this excess liquidity. It's the essential insurance policy for the inevitable withdrawal symptoms when the morphine of stealth QE finally wears off.
We transition now from regulatory efforts to stabilize the financial system to a radically different and arguably more aggressive attempt to stabilize a corporate balance sheet through hyper-efficiency. We're moving from the halls of the FDIC to the server racks of Silicon Valley. Section 2. The X experiment and the rise of the humanless corporation.
And the contrast is really sharp. If the financial world is injecting morphine to mask its instability, the corporate world, at least at X, is engaging in radical, life-altering surgery to achieve hyper-efficiency. And it's doing that by eliminating human labor.
Yeah, the whole pursuit of optimization is alluding to just systematically replacing staff with AI.
That's right.
We have to anchor this in the numbers. The story of X's transformation starts with just unprecedented staff cuts. We know the staff was cut initially by 80%, and then it continued down to a 90% overall reduction. This wasn't just trimming the fat.
No, this was cutting into muscle and bone. And the most illustrative cut was to the safety and spam response teams. These are the human gatekeepers responsible for content moderation, filtering hate speech, the overall quality of the user experience.
And they were cut from, what, 100 people down to just 10?
Down to just 10. And that reduction isn't just financial, it's ideological.
But I have to inject some skepticism here. Doesn't cutting on that scale fundamentally compromise the platform's ability to police itself? I mean, critics at the time said this would lead to a flood of spam and toxic content and just cripple the platform's value.
And that was the widely held belief, yes. But Musk's philosophy, based on the materials, is that human oversight is the bottleneck. Algorithms are scalable, they're unbiased, at least in his view, and they are infinitely faster.
Whereas human moderators are slow, expensive,
and subject to personal biases that create inconsistent policy enforcement. The gamble was that a streamlined algorithm, even if it's flawed at first, would ultimately prove superior to a costly, slow, and unscalable human infrastructure. X started as a test. How little human labor is actually required to operate a global platform.
So the premise is that a human is not just a cost but a liability, if what you're seeking is true scale and speed. And this really sets the stage for the true AI takeover.
Yeah, the role of AI at X has escalated dramatically. And we need to distinguish between AI as a helper, a chatbot that writes an email draft for you, and AI as a substitute or an agent.
And the clearest sign of this shift was that wave of firings at XAI in the fall of 2025.
Correct. XAI, which is Musk's AI company, it eliminated 500 general data labeling employees. These are the workers who traditionally train large language models by classifying data and providing human feedback.
And the reason they gave was revolutionary.
It was. They said that Grok 4, the core AI model, is now superior to humans at general data classification.
So the machine is now capable of teaching itself, or at least rapidly improving its knowledge without general human help. I mean, that's a massive leap forward in automation.
It's the moment where these models achieve a kind of autonomous self-improvement for basic tasks. The only human trainers left are these specialized PhD-level experts who focus on highly nuanced scientific or ethical knowledge gaps.
And that huge workforce cut, it kind of validates the whole humanless corporation idea.
It proves that AI isn't just productive, it's an effective replacement for its own trainers.
Okay, now let's talk about Grok 4.1, which was released in November 2025. This model transitioned into an agent. We need to unpack what that term means for our listeners. What's the fundamental difference between Grok 4 and this new agent, Grok 4.1?
Well, a standard language model, it waits for a prompt and then it generates text. An AI agent, like Grok 4.1, is proactive. It's capable of autonomous decision-making, and it can chain different tasks together.
So it can interact with external systems.
Exactly. It can call APIs, access databases, execute transactions, all without needing a human to approve every single step.
So it's not just answering questions about an advertising campaign. It's actively running and managing that campaign from start to finish.
Precisely. We're seeing Grok 4.1 now performing complex commercial duties that used to be handled by sales and marketing staff. This includes things like writing targeted marketing copy based on real-time user data, setting optimal bid strategies for ad placements, and automatically adjusting targeting across thousands of campaigns.
So it's closing deals.
It's closing deals, it's managing client relationships, and it's optimizing performance autonomously. This means X is eliminating entire layers of human account managers and optimization specialists, directly trading their labor costs for basically AI subscription costs.
And all that early skepticism about X's survival, it was based on the idea that human interaction and quality control were essential. But the data from late 2025 tells a pretty compelling financial success story.
The financial validation is undeniable, and it's the most powerful argument for this humanless model. Despite the massive cuts, or really because of them, X is projected to achieve its first annual advertising revenue growth since the acquisition. The estimate is for a very healthy 17.5% for 2025.
That margin expansion must be astronomical. You cut costs by 90%, and now you're growing revenue by over 17%.
It is. The experiment proves that human labor was not only costly but often redundant to the core function of an optimized platform. For investors, this data is revolutionary. It shows a path to unprecedented operating margins.
It demonstrates that high revenue per employee, a metric we need to focus on, is achievable.
X has proven the viability of this model.
And now this success at X is being leveraged into national policy discussions. The analysis we saw connects X's structure directly to these high-level government optimization talks.
That's the strategic expansion. Musk is reportedly linking X's success to conversations with the Trump administration's Department of Government Efficiency, or DOGE.
DOGE, right.
And the premise is simple. If a global tech company can operate with 90% fewer people, why can't the government?
Which raises some pretty serious political implications. Musk has reportedly advocated for replacing over 75% of the federal workforce with AI, using X as the test bed for national operations. What are the headwinds to that idea? I mean, beyond just how bold it is.
The headwinds are massive, and it's critical for listeners to understand them because they represent the risk to this whole vision. First, you have the political reality of public sector unions, which are extremely protective of government jobs. A 75% cut would lead to immediate, widespread resistance.
And then there are the security and accountability concerns.
Huge concerns. Federal operations from the IRS to the Department of Defense involve incredibly sensitive data. Replacing human accountability with an autonomous AI agent raises immediate questions about transparency, auditing, chain of command. Who's responsible when something goes wrong?
So while the idea of a hyper-efficient, taxpayer-friendly government is politically attractive, the actual implementation faces huge institutional resistance and some very legitimate concerns about, well, about delegating sovereign authority to an AI.
Exactly. X is the efficiency proof of concept. But deploying that nationally means confronting these deeply embedded human and legal systems. For investors, X's success is a blueprint for corporate valuation, but that government parallel shows the vast potential market for these AI agents if they can overcome the barriers.
Okay, we have to pivot to the investor strategy. If X has proven that some of the old corporate valuation metrics are obsolete, what's the new primary focus for evaluating companies?
The paradigm shift is that labor is no longer just a competitive asset. It's now viewed as a cost structure and a liability. So the single most important metric for investors in the AI era is revenue per employee.
Let's elaborate on that.
Oh.
Why is revenue per employee more critical now than, say, just overall operating margins or growth rates?
Because it measures hyper-efficiency. A company can grow its revenue, sure, but if it needs a massive workforce, say 100,000 people, to do that, its margin potential is capped by labor costs, benefits, HR complexity.
The real winner is the company generating $1 million in revenue per employee, not the one generating 200,000.
That's it. Hyper-efficiency means maximizing operating margins by systematically minimizing human labor, just like X did. We have to look for the companies that are rapidly shifting their cost structure away from salaries and towards scalable, one-time AI deployment costs.
So we need to look beyond X itself to the companies selling the picks and shovels for this humanless revolution.
Precisely. Look to the B2B software sector, the ones providing enterprise AI agent solutions. The viability is proven. Now the opportunity is selling the tools to everyone else.
And which specific companies should we be watching based on the material reviewed?
Focus on the big incumbents that are successfully integrating agent technology into their platforms. Salesforce is critical. By building AI agents into its CRM platform, it's directly targeting the replacement of human sales and support teams for all its clients.
Okay.
Similarly, platforms like ServiceNow and Palantir, they specialize in automating complex corporate operations. They provide the infrastructure for companies to turn entire divisions into autonomous agent teams.
And finally, we have to address the fatal tail risk that comes with all this hyper-efficiency. Algorithmic risk. The efficiency gains are massive, but the failure to properly police content or transactions becomes catastrophic.
This is the critical balancing act. When X cuts its safety team from 100 people to 10, it dramatically heightens the chance of a significant failure in filtering illegal content, sophisticated deepfakes, or state-sponsored disinformation.
And that efficiency gain creates a regulatory vulnerability that can be instantly wiped out by fines. The most direct conflict here is with powerful regulators, like the EU's Digital Services Act, the DSA.
Indeed. The DSA can impose massive fines, potentially billions of dollars, on platforms that fail to police harmful content. So if an autonomous Grok 4.1 system makes a catastrophic error in content moderation, the resulting fine could wipe out all the margin gains from cutting the workforce.
So investors have to evaluate how these companies are managing this algorithmic risk.
Efficiency cannot be pursued at the expense of legal compliance. It's that simple. So if we bring these two monumental topics together, we see this dual force of extreme intervention driving today's markets. And both are based on a belief in short-term gain that comes with this massive, concentrated, long-term risk.
On the financial side, you have regulators intervening with stealth QE to prop up the system. It provides powerful liquidity, it prevents a Treasury crisis, but at the same time, it encourages banks to concentrate risk creating the conditions for a severe future crisis.
And then on the corporate side, the X experiment achieves unprecedented efficiency by proving AI agents can replace huge swaths of human labor, leading to higher margins. But that, too, comes with a major catch: heightened algorithmic and regulatory risk that threatens the whole model.
So the investor's path through 2026 is defined by navigating these two unstable realities. You have to ride the financial liquidity wave, so bank stocks and tech, and take advantage of the protection offered to Treasuries, but always hedge against the systemic risk with something like gold.
And at the same time, invest strategically in the enablers of hyper-efficiency, the B2B agent software companies, while rigorously analyzing which ones are best positioned to manage the inevitable regulatory backlash.
Yeah, we're in this unique period where both the financial system and the corporate structure are being radically altered by a move toward automation and regulatory bypass. The systems are being designed for maximum short-term output, but the human element of oversight, of capital safety, of moderation is being systematically reduced.
It's a huge shift.
It is, and it leaves us with one final provocative thought for you, the listener, to consider. We've analyzed systems, finance, and technology that are both moving rapidly toward minimum human intervention. In the financial system, we're reducing human oversight on capital safety. In the tech platform, we're reducing human ethical and safety checks. If efficiency and liquidity are the only priorities, what happens to stability and ultimate accountability when the humans responsible for system integrity are gone, replaced entirely by automated rules and algorithms? Don't forget to subscribe and hit that like button.